Hi, and warm welcome to this year's Tech Fast 50, where we will reveal the fastest growing tech companies in Sweden. I am Viktor, and I will be your host over the next 2 days. When I'm not here, I'm working with analytics within the M&A practice, and with a primary focus on transactions within tech. And with me today, I have my great colleague, Louise.
Hi, Victor, and hi, everyone. My name is Louise, and I work at Deloitte with cybersecurity. And my job is all about helping companies to protect their digital assets, but also to enable business growth. And I'm really excited about today's lineup.
First up, it's all about the word that has been becoming increasingly popular over the last years: profitability.
Absolutely. The days of growth at all costs are kind of behind us. The focus has shifted from pure growth to ensuring that businesses can maintain profitability while scaling.
And in our next episode, we will dive into the topics of investments with an extra focus on exits, where we will get the help of an expert panel to dive deep in these areas.
Yeah, because exits has truly become more difficult. But first, Victor, let's go through how we actually put together the list.
Yes. So the ranking is based only on net revenue growth over the last 4 years. We're also making sure that the companies on the list are having self-developed tech. These are the same criteria as last year and the many years before that.
And speaking about last year, it's been a wild ride economically. And let's have a look. How did things look 12 months ago?
Det är alltså 20 år sedan vi presenterade den första Fast 50-listan. En kategori som rätt och slätt var internet.
Lönsamheten för bolagen på listan har ökat.
Vi står bara i början av att förstå vilka effekter generativ AI kommer att ha.
Cash is not king. Det är ChatGPT menar att det är ett öppet race. Alla 3 bolag har över 5500% i tillväxt.
Det är helt otroligt.
Gratulerar.
Tackar.
Sveriges snabbast växande techbolag.
The last few years, we've seen record growth numbers among the companies on the list. But a little slowdown last year. How does it look this year, Louise?
Well, yes, the trend continues, but everything is in a little bit slower pace. We're still seeing a strong growth, and we're noticing that companies are generally becoming more profitable. Companies seem to be focusing on sustainable growth, but also on solid financials.
Right. For a long time, it was all about scaling fast and grow to all costs. But now, with interest rates far from zero and capital is more expensive, investors and stakeholders are more looking for a sustainable growth path. We have a panel today that will help us discuss this topic in more details.
Yeah, and they will be talking about how companies can keep growing while also staying profitable. It's definitely not an easy balance, but it's a balance that tech companies need to master at the moment.
So we got our 2 experts ready to give us the inside track on whether growth at all costs is a term of the past. First, we have Rinko Goel, Head of Nordics Digital Tech and Communications at Citibank, who will bring deep expertise into this subject today. We're also joined by Joel Silverberg, COO at P Capital Partners, and also the author of a remarkable article on profitability in the tech sector right now. So very welcome here.
Thank you.
Thank you. So let's start with the big pictures. Are we truly seeing a shift in the tech industry from growth at all costs mindset to a focus on profitability? So let's start with you, Rinko.
Yeah, thank you, Victor. I think profitability has always been important for startups and for investors alike. What happened in the last few years, specifically between 2020 and early 2022, it took a backseat. But I would say that phase was a kind of bubble in terms of valuation. My feeling is that every company which has a business model which is scalable and which is solving a real life problem, I think those business models can survive and find a way to profitability. So that's how I feel. I think profitability is required and is definitely achievable if the business model is solving a real life problem and is scalable.
And do you have any extra thoughts on that?
I mean, I think that perhaps there's a bifurcation increasingly after this change in the market cycle, we could say. And there's sort of the frontier tech that continues to be very interesting to generate venture returns. I mean, the best example is AI and OpenAI's big fundraise that just happened this week. There's still businesses that are in this kind of frontier tech. They don't need to generate profitability. I mean, the kind of call option, the ability for those to generate huge upside. Profitability is less important than growth. But I think we've seen a huge bifurcation, which is, as you say, I think the vast majority of businesses are in the latter category, which is you need to be solving a real problem that's valuable. And how do you quantify something that's real and valuable? Well, you need to make some money. You need to have revenue traction. You need to have unit economics, et cetera, et cetera. So I think, for the sliver of companies that are truly in, the most innovative industries, no. But that for most, yes.
And do you think this shift is real, or will this again be forgotten in a few years from now?
Yeah, I mean, of course it's real. I mean, I think you can look at some of the data that's coming out from PitchBook. Funding for growth companies is down 70% year over year. So there's just less capital available in the ecosystem. And I think a lot of the reason that there was this jump to profitability is there just isn't money to raise. So, you can think about all the strategy about, growth versus profitability and, TAM versus slowing down to have a more sustainable business. But, really there is the very pragmatic issue of runway. And, are you going to continue to be able to build for 24 months? And I think, the facts are there, which is essentially that there isn't capital in the ecosystem like there was, at least at the peak in the height of COVID.
Yeah. I think just to add what Joel was saying, when it comes to private capital, I think there's a buyout space and then there is a venture capital space. On the buyout space, I think private capital is available. And if a private equity company wants to buy out a sort of mature company, I think we haven't seen that much of a capital down round in the last few years. But when it comes to venture capital, which Joel was just referring to, there's a real dearth of capital. And I think the primary reason also is a lot of VCs have not been able to return money to the LPs. And it's a vicious cycle, right? If LPs don't get the money back, then how do they do a fresh investment? So that's where I think a lot of these startups have been caught in terms of not having enough capital. So profitability does become important.
Yeah. And in this new landscape, so which tech companies are best positioned to thrive with the focus on profitability? If you can continue there, Remco.
Yeah, I think to me, and this is sort of also what I gathered over the past few years, 4 important things from a model point of view, how should the companies look at. One is the problem that they are solving. So is the product market fit and is the problem they're solving sort of really a real life problem? Second is, I would say, people. So what are the kind of people in the company? Does it have good founders and management who can navigate through the various challenges? The third, I would say, is process or the path. So are the founders and the management able to navigate through the various phases? Can they bring in cost efficiency when required? Can they dwell on the unit economics? And the last but not the least is price. When it comes to price also, I've seen a lot of times companies are hesitant or the founders are hesitant to take benefit of the ecosystem because they get caught into something called an ecosystem. And why I say that is because a lot of time founders are hesitant to do down rounds or not willing to take funding at a lower valuation. But to me, valuation of a company at any point of time is not what last valuation was, or not even what the founder is thinking it should be. It is what somebody is willing to pay at a given point of time. So you save the ship first and then you sail later on, is what I would like to say here.
And then shifting from this growth first model to a profitability first approach. It sounds complex. So how can tech companies make this shift without jeopardizing their market value? If you want to answer that, Joel.
Yeah, I was just reflecting on your answer. I think that was a very good summary of what makes a business well-positioned for making that transition. I guess to add a little bit about I would say maybe two things off the top of my head. One is, I mean, I think you see sort of two types of situations where you're making the transition from growth to profitability. One is perhaps one where a business is overfit for scale. Maybe overfit is the wrong word, but essentially you sort of built an OpEx structure that's larger than the market you're chasing after the 2021 sort of market adjustment. And in that situation, it's about, you know, driving efficiencies and reducing cost. And it's really about tenacity and building a good culture. And can you sort of navigate this very tough time where are your people incentivized, even though maybe valuations change and the cap table needs to, you know, go through some restructuring as well. And I think that comes a lot down to the management team and how well can they incentivize, you know, their organization, and how well can they sort of drive change positively through what is a pretty difficult time. And then I think there's if I were to choose one, I would choose that situation. But the other one I think is sort of, you haven't monetized, or to use, I think the right word, which is, have you found product market fit? And if you were sort of in the middle of growth at all costs and you know, were investing all into top line without investing into sort of depth of product fit, you now find yourself in a situation where maybe you haven't even charged customers. And this is a much more difficult problem, I would say. I mean, it's less of a cultural problem, more of a real business challenge. Okay, how do you transition from top line to, you know, creating monetization strategy, figuring out how to price your product, and going through the very challenging process of figuring out like what are sustainable unit economics that you can build your business off of, and trying to slowly get in, you know, slowly back into that, as you say, without destroying growth. I mean, you need to keep the valuation of the business high, you need to maintain growth, but also you need to push into those profitable unit economics.
And as a follow-up there, so what immediate changes are necessary if one is planning to go a little bit down in the value chain of the company and not just focusing on the top line?
Yeah, I mean, I think that this exercise of essentially designing what is product market fit for your business is really essential. So I think when you're not looking at sort of just hypergrowth, you need to figure out what is a business that is sustainable and makes sense, not just from an ESG perspective, from an economic perspective. So, you know, what acquisition cost and what, you know, pricing is going to, you know, create economics that you can, you know, basically have an OpEx that works off of. And if you can sort of do that math of what are your customers willing to pay and how much margin does that punch out and what is my, you know, spend on managing the business, that sort of napkin math plus, you know, more qualitative assessment of your customer base is like the essential building block, I think, for charting a path through profitability.
And is there anything you want to add there, Rinku, on the sustainable growth and the key success factors?
Yeah, I would just want to go a bit back into maybe diverting away from the topic a bit, and how these companies grew 25 years back when there was not enough venture capital, and now what is the difference now? So if you look at a company, say 25 years back, not enough venture capital, these companies would make small changes in the business model, figure out whether it's working, still trying to be cash flow positive. If it's working, yes, they would take another incremental step. Not working, they would go back and change. What happened after venture capital came in, the whole cycle of 20-25 years of growth shrank to 6-7 years. So the whole sort of 1/3 of the time frame. And that allowed these companies to experiment faster, hire faster, make 3 times more mistakes as well. And venture capital was able to support these mistakes and hiring and all of that. So the point that I'm trying to make is there is definitely a way to preserve market value and still grow, maybe not as fast as 6-7 years because you're trying to squeeze 20 years of growth in 6 years. But there's definitely a way. And there are definitely short-term strategies and long-term strategies. In the short term, for example, take a SaaS company, for example, right? Some of the short-term strategies on the supplier side, you renegotiate with your suppliers. On the customer side, go to your customers and say, instead of a monthly revenue, why don't you pay us yearly and we'll give you some discount? Yeah. On the employee side, maybe reduce the salaries of employees for some time. So what I'm trying to say is there is short-term way to preserve certain capital. But in the longer term, I would go back to my previous answer, which was the business model has to solve a real-life problem and has to be scalable. As long as you have these two in your model and you have good investors, there's a way to preserve market value.
If we look at the exceptions here, I think you already mentioned one here, Joel, OpenAI, which I think last time I read are planning to have, or forecasting to have a loss of $5 billion USD in 2024. And they're also loss-making until 2030 in their latest forecast. So what are the key factors for some of the companies still being able to have this long-term runway without any profits? What are the key factors for those companies?
I think this is really just a function of fund math. Maybe that's oversimplistic, but I think essentially it's just risk and return. So if a business is able to illustrate that it's going to potentially capture a large enough market, then it can take larger risk. And so if you're building a company with groundbreaking technology that's potentially going to win global markets or open up new markets, you can afford to run unprofitable. And of course that, if the prize is bigger, then it makes sense to run at that, kind of growth at all costs model. But I think, this, as to my earlier answer about the kind of bifurcation of companies, I think, it's not that growth at all costs has disappeared. It's that the aperture for what is a growth at all costs company has very much narrowed. And I think to your point about the funding landscape and how businesses have been built, I mean, the last 2 years were an anomaly, and I think it's a mistake to always be benchmarking to the height of COVID. I think from a VC funding perspective or from a funding perspective, things are in line with a 10-year trend. And really what's going to happen is that we're going, as the aperture of high-risk businesses re-narrows to sort of the most game-changing technologies, we're going to see new capital structures enter for the wide swath of alternative or sort of regular businesses. And I think we're going to see, perhaps this is a different question kind of, but I mean, I think for those businesses, we're going to see different types of funding models. So we'll see more structure, maybe more credit, maybe equity with terms, et cetera.
But if that is like the larger companies, is it also okay for small companies, startups, to have such a long runway until they get profitable?
Yeah, just going back to the OpenAI example, I think, again, referring to my two initial points, whether the company's business is solving a real-life problem, OpenAI, yes. Their app is as much popular with enterprise customers as, say, consumers, and they do help people in a lot of tasks. So yes, it's solving a real-life problem. Whether it's scalable, yes, again, they are the fastest company to achieve $1 billion in revenue, faster than Google and Facebook. So yes, they have a scalable business model. And then the last thing is investors, right? They have Microsoft as one of the backers, which is the third most valuable company globally. So I would say OpenAI is an exception in that sense, might be a bit more typical or difficult for younger companies to follow that path. And I think they might have to look at profitability a bit earlier.
So that's wrap this up. So thanks for a great conversation. This was some super information you shared with us here. So thanks a lot, both Joel and Rinko.
Thank you. Thanks, Victor.
Louise, I hear we have some interesting data on the companies on the list.
We sure do. Our deep dive analyst, Rasmus, is ready to break down the numbers and show us what's happening behind the scenes.
Thank you very much, Victor and Louise. As Victor mentioned in the beginning, his speciality is analytics within M&A. So with Victor and his team's help, we have been able to put together some cold, hard facts for you to do whatever you want with. We're just presenting the figures, not issuing any opinions. And Fast 50, it's all about growth. So we have started to analyze the growth on the list to see if we can find some pattern in the growth rates for the last couple of years. So here we see in 2022, the average growth rate for Sweden's fastest growing tech companies was 2,218%. In 2023, a little bit lower, and even lower in 2024. And the hot topic seems to be, show me the money, to quote Jerry Maguire. It's a great movie, by the way. But we've been talking about profitability. You need to be able to show that you're able to make revenue. So let's see how it looks like on the Fast 50 list during the years. So in 2022, there were 22 companies that had larger revenues than costs. In 2023, there were 15 companies only that were more profitable and 35 companies that still had a negative earnings. But here in 2024, we can see that it's 27 companies that are considered more profitable in terms of money at the bottom line of the profit and loss statement. So for the first time in 3 years, there are actually more companies on the Fast 50 list making that money that we need. And we have analyzed this, of course, against the market. So we have gathered some stats from roughly 2,000 companies that are in the same line of business as the companies on the Deloitte Technology Fast 50 list. Let's take a look how it looks like. In 2021, the revenue margin was basically roughly around 11%, quite flat to 2023. And as we saw in the previous picture here, we can see that the margins are still negative, but they are improving compared to the market, which is quite flat. And in this panel today, we talked about if you have a scalable business that are looking to make future earnings and you have an idea that you can scale and grow and increase sales, then the possibility of future earnings is quite good. So what we have done is that we have gathered some stats from the 5 largest companies on the Fast 50 list this year to see how the margins looks like for them. Let's take a look. So we see here that the average revenue for the 5 largest companies on the Fast 50 list is 271 million, versus almost 52 million in the market. But now we get to the good stuff, the cherries within the cake. How does their margins look like? We can see that it is higher for the largest companies on the Fast 50 list compared to the market. So they are making more money, they have better margins, and they're selling more, meaning that quite profitable company. These can go to Jerry Maguire and say, you know what, Jerry, we got that money for you. But that was all for me, so I hand it back to you, Viktor and Louise.
Thank you, Rasmus. That was some fantastic insights you had there.
Very.
All right, now it's time to reveal the list. Position 50 to 31.
Yes, we have some awesome, outstanding companies that have managed to pull off fantastic growth.
And there they are. A big congratulations to these amazing companies.
Whoop, whoop.
And that's a wrap for today. But don't forget to tune in tomorrow again, where we will talk about exits and investments in the tech sector.
You don't want to miss that.
Thanks for joining us today, and we'll see you tomorrow again.
See you tomorrow.